you. Like my Excel is visible to you. I am assuming yes.
Yes, sir.
Okay. Now, guys, this is a perfect example of how the finance lease first of all is done in the books of this lessee guy. Okay. This I would be giving an example by the name of effective interest method. Before I begin, these are some of that like what I would say the given stuffs for you, like how the lease contract happens. So in a lease contract, in this there is a lease payment of every year 15,000 per year for a tenure of 4 years. First of all, now there is something by the name of interest rate expense, which is 7% per annum. That interest per annum, you can think of it as nothing but the in EMI there are two stuffs now. There is interest and there is principal. So the interest stuff is standing somewhere at 7%. Okay. Now at the initiation, like this is my like what I would say a thing to focus when we will be doing this numerical. But before I start it, it means to say that at the initial, at the point zero, the lease liability, which is at the liability side of your balance sheet, versus the RAU at asset, which is on the asset side of your balance sheet, both are standing at the same amount before they begin, like before they begin their journey. But what happens, guys, especially in the finance lease, like this, what I would say, the finance lease part, they they are having a different year on year value, which are that the ROU value at the year two versus the what I would say the lease value at these liability value at the year two. So their year on year values will differ with the passage of time, but their journey begins at the same amount. Okay. Now this I have written, like this is the example that I have like recreated. So what I mean to say, this is your like calculator command. What it means to say, like we have to derive the present value with the given of all these conditions. So they mean to say like the number of years are 4 years. I by y, I like if you want to do, you can do it my side also. Like the number of years are 4, n is equal to 4. I by y is equal to 7, that 7 percentage. The PMT I have written it by the like signage of negative 15,000. First of all, reason being it's paid out of your pocket, and the future value is assumed as zero because it would be like after the passage of useful life, the asset won't be having any value. So its FV is equal to zero. And the CPT PV, like post of all of these, you can like press CPT PV. The present value would be coming as 50,808. But if in Excel, like if you have to do, this is the formula that I have used. It means to say, let me recreate it over here. So the present value is nothing but the rate. So the rate over here, it's 4, sorry, it's 7, and it's written at 0.7 first of all, guys, over here. Then the n per is the number of like the period of the payments. They mean to say it's 4. And again, they are asking about the PMT. It's nothing but minus 15,000 comma FV it's 0. And again, like it's 0 for the end of the period that I'm taking and just pressing, and it would be giving you, this is how that the present value of 50,808 calculated in Excel. But for your exam, if you need to calculate, I have like shown you in corporate finance like how to calculate the present value, future value, and all of those like the PMT. So going by that logic, you need to just see that class like wherein I have told you how to use that calculator's keystrokes of your like BA plus calculator and derive the CPT PV, and this is how it's done. And in Excel, this is the formula. Okay, this is just for your like quick walkthrough that I've done. Now, this there is this ROU. ROU asset is as good as asset that I told you. Now, in your balance sheet, you have to recognize the depreciation. How the depreciation would be recognized is, guys, like the present value, that the amount which is the asset value which you have like as good as purchased in your balance sheet. Now you have to divide it by the number of years, 4. Reason being, I need it to be standing at zero value after the completion of 4 years. So it's sort of SLM, straight line depreciation, that I've recognized. It is 50,000 divided by 4, that is equal to 12,702. This is how that I have done the depreciation part. Now, this the thing which we are going to see now, it's something in the finance domains known by the name of effective interest method. Okay, this effective interest method is even like taught in the part of lease, even in the parts of pension, but you won't be asked a complete long numerical on this in your examination day. It can be a part of level 2, but it's not a part of level 1, that they might be asking you a big question of like how to calculate the interest part, principal part, the ending lease liability, book value, all of those stuffs. But this is how you should be focusing on how to like first of all analyze the investor's point of view, like whether to invest in this company if it has purchased a lease liability. And yes, the theoretical questions which might be asked in your exam might be based on this. So on going by that logic, I'm just starting it. I'm first of all telling you that in this column, there are the number of years starting from 0 to 4. There is beginning liability. Beginning liability, I mean to say the balance sheet liability that I told you on the liability side. Okay. Then there might be some interest, the yearly interest, which might be recognized on that part of that EMI, which I told you to think of it as like EMI, the interest and the principal are a part of that EMI. So interest would be charged on the opening balance sheet liability value. So it means to say the I value would be charged on this H column only. You can see it over here also. The rate of interest I fixed it at 7%. Then there is lease payment, that is 15,000 per year, that is paid out of your pocket on a yearly basis. So it's a complete fixed amount that 15,000 would be paid. And in the K column, I have shown you by the name of like what I told you, that is principal repayment. So principal repayment is nothing. Let me tell you one thing. Like in EMIs, guys, what happens in EMI? It's like what I would say, a combination of interest amount plus principal amount. So going by that logic, they mean to say the lease payment that is done is nothing but a combination of interest plus principal. So this 15,000 includes both interest as well as principal. So if your interest expense amount is determined, so you can determine it like as a balancing figure, the principal repayment. That I means to say 15,000 minus interest will give you the principal amount. So it is by that logic. And yes, the L column starts with your like what I would say that your closing, sorry, not closing, I've just modified it to 50,000. Reason being, it's more of like what I would say 50,000, it's more of like round of figure for 50,808. So it would be helping you in terms of like rounding of part. So the L column is actually your lease liability part, and in the M column it's more of your ROE asset part. So the so just I begin before I begin, I mean to highlight these two things. Like at the start of that asset value, the 50,000 value is same for both of them. That means to say that the liability part as well as this asset part, this is your asset part. In your balance sheet at the start of this, the value is same, but on year basis, you can see in the year one, year two, year three, year four, the value is again same. They are standing again at zero. But between the like the tenure, the values between all of them, it's first of all differentiating, like it's fluctuating, keep on keeping on the facts like how it's recognized as an interest, how the depreciation is done. So let me focus first on this M part, that is your asset part of your balance sheet. Then I would be focusing on this liability part, how this L is determined. So the M is nothing but that in your books of account, on asset you have to recognize only depreciation, only depreciation that you have to focus when you're thinking about the right to use of that asset. So on that logic, sorry, on that logic only, I'm just recognizing that this is your 50,000, that is your book value. And year on year basis, I'm recognizing this depreciation, which I have calculated just over here, that year on year basis, this is the depreciation amount that would be charged. And at the last stage, that is the fourth year, the value would be completely depreciated, and post that there would be zero value for that asset. So this is how that the book value is determined. It is nothing but asset minus depreciation only. Okay. Now let me come on to this L part, like how the liability side is determined. Liability side, it's starting with 50,000 first of all. Now the closing value of the year zero would become the opening value of year one. Okay. And on that value, the interest would be charged because it's said that it's outstanding for the complete year of your opening balance value. So on your opening balance value, which is 50,000, there would be interest expense of 7%, which might be charged. And now you have to deduct this interest expense out of your lease payment, because the lease payment are considered nothing but as the interest plus principal. So your principal amount would come as a balancing figure out of this 15,000 minus 3,500. So this would be your principal repayment, that is 11,500. Now your ending lease would be nothing but your opening liability minus the principal that you have repaid. It would be helping you to in order to bring your liabilities come to a downward value, come to a down value with the passage of time, since your asset is also depreciating now. So that means your liability should also be depreciating. Reason being, you have used that asset for a good amount of time now. So with the passage of time, the depreciation is coming, and also the asset value, your liability value is also depreciating on that basis only. So this is the logic you can have in your mind for the decrease in value of liabilities. And yes, of course, your principal amount is repaid also, na? Like think of it as you're financing the repurchase. So that way, the L part, the L column is depreciating on the year-on-year basis. N- Here I have highlighted on this K column. So I mean to say in this K column, like if I have dragged the formula like till over here, what would happen, guys? Like it would be okay, one second, let me drag it over here. So what happened, like if I have dragged the formula over here, it would be showing me a negative value in the L 15 cell. So it is showing me a negative value at the end of this 4 year, which can't be the scenario because the asset is completely utilized in the 4 year span. So it can't be that the asset can have a negative value at the year end. So the asset should be having a, first of all, a zero value. And for that to be possible, we need to pay the entire outstanding amount. I mean to say the entire outstanding amount, that is the 13,000, which should be paid out of your pocket as a part of your principal in the last year. So it would be that you have paid this 13,000 opening liability along with the interest that is accrued for the year, and on that basis only that your the closing liability would come to zero. Let me adjust the formulas. So this is how it is done. So the focus area over here is that in the K15 cell, the principal repayment is completely equal to the closing value of the last year, that is 13,000 over here. And in the M column, we have studied in the depreciation in the last week that the asset value can't depreciate further than its useful life. It has to be equal to zero if you're going by the name of this SLM method. And in the very fifth year, the value of the asset would be zero. And we are seeing it over here also, like the depreciation is like completely gone to zero, because here in the value is completely, what I would say, recognized in the book of accounts as a depreciation. And in the M15, it's as good as that your value is zero. So the conclusion to have from this lessee book, finance lease, is that start value is same, end value is same in both the liability and the asset side, but year on year the values keeps on changing. Okay.